Good morning. I'm Tracy Gordon, Vice President of Tax Policy at the Urban Institute and co-director and acting Robert C. Posen Director of the Tax Policy Center. It's my pleasure to welcome you to Radical Tax Simplification, the Impossible Dream. One of my favorite news photos ever appeared in a 2013 New York Times story about a bipartisan push for comprehensive tax reform. It showed then Senate Finance Committee Chair Max Baucus reacting to something that a voter told him and then House Ways and Means Committee Chair Dave Camp as they crisscrossed the country. The voter's suggestion, get rid of the deductions that don't affect me. Excuse me. Today, my TPC co-director Bill Gale and a bevy of other experts will talk about why that reaction is not unusual. In short, tax simplification is anything but simple. This is not just because of self-interest on the part of taxpayers, although that's certainly part of it. Rather, the tax code is trying to do many things at once: raise adequate revenue to operate federal programs, promote behaviors like owning a home, giving to charity that American voters and their representatives think are good for society, smooth out differences in access to opportunity, and keep the U.S. competitive on a global economic stage. On top of that, we live in a very different world from 1986, the last time a major tax simplification effort succeeded. New technologies have enabled the spread of information and misinformation. A broader set of voices, experiences, and perspectives are contributing to policy, even though some voices still lack equitable access. Most important, political polarization complicates achieving even the most basic functions of government, much less solving entrenched problems. But there's hope. None of us would be here today if we didn't believe strongly in the ability of sound analysis grounded in the best research and experience to affect the terms and the outcome of the debate. To that end, Bill will discuss a paper on tax simplification, and then, technology permitting, my TPC colleague David Weiner will demonstrate a new tool available on TPC's website. We're fortunate to be joined by the Wall Street Journal's Richard Rubin, who will introduce contributors to a panel discussion. We'll welcome your questions at various points along the way, and for your information, this event is being recorded and will be available after the discussion concludes on the event page. The late Steve Jobs said, "Simple can be harder than complex. You have to work hard to get your thinking clean, to make it simple. But it's worth it because in the end, when you get there, you can move mountains." Given the many ways that taxes affect our daily lives, economic prosperity, and well-being, it's easy to see how simplification done right can indeed move mountains. So my TPC colleague, Bill Gale.
All right. Thank you all very much for being here today. Tax simplification is an old topic. You can read about it in Adam Smith's Wealth of Nations, where he talks about the vexation that people face from taxes, and then there are a whole series of other great quotes and great stories in the history of taxation. So the question is, why talk about this now? And the answer is this is a good time to talk about tax simplification, both for kind of short-term and medium-term reasons. The short-term reason is that it's tax season, and tax simplification or tax complexity is a very salient issue right now for a lot of people, myself included. And the second is that 2025 is shaping up as possibly a big year for tax proposals. And simplification options deserve to be on the table. They're certainly more imaginative and more constructive in some ways than the debate so far, which is basically extend the provisions of TCJA or don't extend the provisions of TCJA. So it seems like the right time to talk about simplification. I will have two kind of initial qualifications. One is I'm not going to give you a magic bullet about the plan that's going to work for everybody and it's going to solve all the problems. As Tracy very appropriately indicated, simplification is hard. And if nothing else, we're starting from a complicated system. So getting to a simple system can be complicated. The other thing is, if you don't like the proposals, blame them on me. Do not blame them on the Brookings Institution and the Tax Policy Center. Those organizations do not take positions on issues. Scholars do. So if there's a problem, direct it at me, not the institutions. It may have been the influence of the NCAA tournament and the pending Final Four, but everything fell out to me in this paper in terms of fours. So I'm going to start with 4 overarching themes, then give you 4 qualifications or caveats and how to think about simplification, ask 4 questions, and maybe that's a Passover theme. Then I have 4 proposals and 4 conclusions. So let's just start. The first, the themes. How do you think about tax simplification? The first theme, which I don't really need to belabor, is that there's massive potential for simplification. Or let me actually, I should say, there's potential for massive simplification. All right, the tax code is complicated in numerous ways. I think we all know that. I won't belabor that issue. The second point is the one that I do want to belabor. Excuse me, and that is there's no such thing as just simplifying the tax system with just in quotes. And I say that because the most common complaint you hear is like, just make it simple. And that's understandable, but it's not doable without changing some other feature of the tax code. The tax code didn't get complicated by accident, and there is a reason for all the complexity features in the code. You may not like the reason, but there is a reason. And so if you simplify the system, you will inevitably be changing some other aspect of the system that someone cares about. The third point is, although we talk about simplifying taxes, we really mean simplifying people's interactions with the government. All right, you could simplify taxes by getting rid of any preferential treatment at all and making them all spending programs. So filling out your taxes would be easy, but you'd have to go to HUD to fill out a form to get your mortgage interest deduction. You'd have to go to HHS to get your child credit. You'd have to go to Treasury to get your charitable contribution credit deduction. You'd have to go to Energy to get your electrical vehicle credit. That would be, even if we kept the same set of policies, that would make taxes simpler, but it would make interactions with government harder. And that seems counterproductive. So we're talking about simplifying taxes, but we're thinking about simplifying interactions with government. And finally, the key question here is the marginal value of complexity, not how complex the overall system is, but what are we getting for value on the margin. And the important thing there is that it's a social value of complexity, not the individual value. Like suppose there was a provision where you had to fill out 2 extra lines of code on the tax form, and you got a $1,000 tax cut for it. You might think, hey, that's good complexity. I kind of like that. But if government has to raise the same amount of revenues, then there's going to be an increase somewhere else. And what you have is everyone paying the same amount of taxes as before, but having to fill out 2 more lines on the tax code. So we want to focus on social complexity, social value of complexity, or social costs of complexity, more than the individual costs. All right. 4 caveats. As Tracy said, simplification is complicated, so we are not talking about all simplification options here. We're talking about federal taxes, not state taxes, although if the federal government did some of the things in the proposal, it would help a lot if the states conform their systems, and the federal government could well give incentives for states, either financial incentives or administrative incentives for the states to conform their tax system. We're talking about the individual income tax, not the corporate tax. I have nothing against simplifying the corporate tax. It's just not the topic of this paper. We're talking about costs for individuals mainly, not for the IRS. My view is that if costs are shifted from individuals to IRS, that's a net gain, that the IRS is more equipped to handle tax compliance administration issues than individuals are. And so my main goal is getting individual costs down. Last thing, we're talking about most people, not all people. If you trade cryptocurrency or you're a real estate magnate or you run a bunch of businesses, your taxes are going to be complicated, and this proposal doesn't really get at that. But for 3/4 of households, maybe more, maybe a little less. There's very meaningful tax simplification here. All right, so let's start with some background on complexity. Why are taxes complicated? Everybody dislikes complicated taxes. Why are they complicated? And the way I find it most useful to think about that is to answer a question with a question, which is, well, why don't we have the simplest tax possible, which is a head tax? And when you put it that way, there are immediate objections. It's not fair. When the United Kingdom did something similar to a poll tax in the last century, they had riots. People don't like poll taxes. They don't like head taxes. So immediately you get in the first issue, which is there are trade-offs among policy goals. If you want to move away from a head tax and make the system more fair, you've automatically made it more complicated. But there are other goals too. Reducing avoidance requires sometimes some detailed rules. Reducing tax evasion, policing of tax evasion affects the complexity of code. Providing incentives for particular activities or for overall growth often complicates the code as well. So that's one issue. That's the basic fundamental issue. The second issue is the lobbying process, and I mean this kind of little L, not big L. People naturally go to Congress asking for preferences for their activity. Everybody thinks they are special. Everybody thinks they're above average. Everybody asks for special dispensation. This is compounded by policymakers' penchant for using the tax code to solve any potential social or economic issue, even when it's a completely inappropriate instrument. But the efforts that people make to approach their congressmen about their own situations typically generates complex taxes. And of course, it's a cascading issue. If Group A gets a subsidy, Group B says, hey, we're kind of like Group A, we should get a subsidy. Group C says, we're kind of like Group B, we should get a subsidy, and so on. So the lobbying process matters. Third, complexity is hard to measure. I'll talk about that in a second. There are kind of standard measures, and there's a new measure that I'll show you in a second. And fourth, taxes are complicated because the world is complicated. I put finance and child care here, and I think everyone kind of nods their head and says, yeah, finance is complicated. There's a lot of stuff there, but child care? Yeah, taxing child care, subsidizing child care is complicated. Suppose you want to subsidize licensed child care, but you don't want to subsidize ski lessons in Aspen, okay? You have to draw a line, if you're the regulator or the Congress, you have to draw a line that takes every activity between those two things and places them clearly on one side of the line or other, knowing that people are going to try to game the system and get onto the other side of the line. So even something like childcare can be remarkably complicated. And if childcare is complicated, you can imagine health or housing or anything else is complicated. All right, so lots of reasons why taxes are complicated. How do we measure complexity? There are some standard measures. Joel Slimrod, about 40 years ago, proposed what seems like the most obvious measure, which is the sum of the administrative costs borne by the government and the compliance costs borne by individuals or businesses. There are some issues with that, which I won't go into, but it seems it's a relatively useful measure. It's not ideal. And Yosef Ben-Zardi at University of California, Santa Barbara, who's been doing the best work on simplification the last 3 or 4 years, proposes using number of words in the tax code. Again, there are some obvious issues with that, but it turns out across a lot of countries, across a lot of time, the tax codes are getting bigger and bigger. So think of it as circumstantial evidence, not convincing evidence. There's a new measure, though, which I just saw a couple of days ago, which is that a survey showed that 54% of Generation Z members reported that paying their taxes brought them to tears. And 38% of millennials report the same thing. 1 in 4 Gen Zers reported to have sought help from a therapist to recover from the experience. All right. Now, I do not believe these numbers. All right. I don't know where this survey came from, or Cash App, but surveys are inherently manipulable, so I'll give you that. I will just say, if people are asking questions about whether filing taxes brings you to tears or sends you to a therapist, that should be enough, regardless of what the actual numbers are. So I wouldn't necessarily buy into these numbers the way some other numbers, but if people are going to a therapist to deal with taxes, there's a problem. All right. So why is a complexity problem? Well, I think I just told you the main reason. But the tangible costs that imposes on individuals. There's an enormous range of estimates in the literature. I found 3% of revenues to 17% of revenues, and part of it is the 3% don't count all the various costs, and part of it is the 17% kind of overestimate some of the costs. For example, there's a time cost involved, and you have to attach a wage to that. So if you attach a big wage to that, you get a very big number. So I would use 10% of income tax revenues as a rough measure of the individual compliance costs of income tax. These costs are distributed regressively. That is, they're higher as a share of income for low-income households, but they're higher in absolute dollars for high-income households. And they're higher in the U.S. than other countries because we tend to run our social policies through the tax code, whereas other countries just go ahead and spend the money. So those are the tangible costs. There are also the intangible costs. If you have a system that's complicated and opaque, everybody thinks that everybody else is getting away with something. And to some extent, that's true. And to some extent, even if it's not true, it affects people's attitudes toward the tax system. Benzardi has shown in a recent paper that people think that complexity makes the system less progressive, and they think it makes the system more easy to evade. And they show that in this survey, people are willing to pay about $150 to simplify the system. That might sound like a lot, but that's basically what you pay a commercial preparer to do your taxes. All right, last question, which features of the code affect complexity? No surprises here, the base, the rates, and the deductions and the credits. The proposals below focus largely on the third item. It keeps the progressive rates structure, but eliminates preferential rates, and keeps essentially the same, a fairly broad base of the income tax. Then there are administrative features that help a lot. Withholding at source is a key to simplification, and this has been known as far back as Adam Smith advocated an estate tax over inheritance tax because it was easier to collect money from the decedent than from the people who actually obtained the money. And then filing, pre-populating or no return systems can also help people. They exist in other countries. We're beginning to talk about them in the U.S., and I think there's big potential there. All right, let me turn to the 4 proposals. Finally, let me just mention they're all revenue or budget neutral with respect to the current system. The system existed last year. Each of them is more progressive than the current system. And I mean them, I put them forward part as advocacy and part as education. There are some trade-offs involved. As I said, there's no cure-all. But I think by presenting a menu of options, you can get a sense of what the options are for simplification. So the simplified income tax is, I try to live up to the name simplified here. It repeals all itemized deductions, repeals all preferential rates, eliminates the AMT, but that doesn't matter once you've got rid of the itemized deductions. It repeals all credits in the system, and it repeals the head of household filing status. In exchange for that, we introduced 2 things. One is a credit that goes to each person, each adult and each kid of $1,000 was fully refundable. And the second is to replace the EITC. There's a work subsidy that's 20% of one's earnings up to $20,000, and then it phases out when the individual earns $40,000. Let me just say a couple of words about each of these provisions. Oh, sorry. So ultimately, the tax calculation process is simplified. You state your marital status, you report your sources of income, the filling out of deductions and credits is incredibly simple, and you look up the tax in the tax table. So this is still a progressive income tax. It still supports low-income households, households with kids. It still supports work effort, but there's still high-end complexity. Again, if you're trading crypto or running a real estate empire, you're going to face complex taxes even under this system. For itemized deductions, I'll just mention that as of 2017, itemized deductions are used almost predominantly by high-income households. So removing itemized deductions is a way of simplifying the system, raising taxes on high-income households without raising statutory income tax rates. The mortgage interest deduction is probably the hardest one to repeal, but it's the easiest one to justify repeal of in terms of lack of impact on home ownership rates and significant impact on the price of houses, the size of houses, the debt-to-value ratio, and so on. Charitable contributions, I'll just say, was the hardest call for me. I wanted to keep the proposals consistent and not do what Tracy said the taxpayer did, was get rid of all the deductions except the ones that I happen to like. So charitable contributions went in the dustbin as well as the other proposals. Preferential rates, lower capital gains rates, and the deferral of capital gains are sort of the basic mechanism behind all tax shelters in the economy. And so taxing at the ordinary rate would help. Taxing gains at death would help, but that's not in this particular proposal. The revenue estimates that I mentioned, that this revenue neutral, do account for changes in estimation behavior, and so getting rid of the preferential treatment capital gains, I think, is important. Getting rid of Section 199A, which is the business income deduction in 2017, I think is also important for a variety of reasons. It's complicated, it's regressive. It does not seem to have boosted business formation or anything like that. So that's a thought there. The head of household benefit structure rises. The benefits rise with income. It's an upside-down subsidy. The EITC is remarkably complicated and has low benefits for childless workers, and the child credit, which has been annoying me for 25 years, does not reach many families, not because their income is too high, but because their income is too low. And if the goal is to help kids, presumably the kids that need it most are in the families with the lowest income. All right, the personal work credit, I mentioned $1,000 per person, including each kid. It's fully refundable. I don't emphasize it in this proposal, but it's basically a universal basic income, a very, very mini version of a universal basic income. The work credit depends only on your own earnings, so it's phased out as your own earnings rise. It doesn't depend on family. It doesn't depend on family adjusted income. So it could actually be administered through the payroll tax, even independent of the income tax. And then the problem with it is some high-income households will receive it. The part-time working spouse of a CEO might get the EITC. That is an example of a trade-off. That's the price you have to pay for getting rid of 15 pages of instructions on the EITC. All right, this is a progressive tax, a progressive change relative to the existing system. This graph shows particularly strong benefits in the lowest income groups, and then increased taxes at the top. There is one problem with this, though, and that is it hits families with kids in the lower moderate income ranges hard because of the removal of the head of household status. So this leads to Proposal 2, which I think in my head is like Proposal 1A, but it's exactly the same as Proposal 1, except the credit goes to $2,000 and then it phases out over time. And this is an example of the trade-offs that one can make in tax policy. So the dark line here is the original proposal. The lighter line is the modified proposal. You can see it helps more at the bottom, and then it's basically neutral for the next several categories, and then is progressive at the top. If those middle categories are bothering you, you could make the credit $1,500 and phase it out at higher income levels. Okay, so it's just an example of how these trade-offs affect the implications of tax policy, and example of the fact that you can't just simplify the system. You're changing, in this case, the distribution as well. All right, Proposal 3 is different. It's based on Michael Gratz's 1997 book. He called it Back to the Future. It should really be called Forward to the Past, but the idea is as follows. Same change. You start with Proposal 1, all right, and then you raise the standard deduction massively. You raise it to $100,000 for a married couple, and you use that. That, of course, is tremendously simplifying for many people. They just don't pay taxes, but it costs money. So you create a value-added tax of 10% to help finance that. Then there are two more changes you need to make to adjust that in terms of revenue and distribution. First, all the income tax rates below 25%, the 10%, the 12%, I think 22 and 24, those all get bumped up to 25%, but only on income, above the standard deduction. So above $100,000 for a married couple, 50 for single. And the other is the VAT can be regressive, but if you raise the personal credit from $1,000 to $2,800, you offset that. So, for example, a family of 4 would get their personal credit raised by $7,200 relative to the initial proposal. That would pay for their consumption in their first $72,000 of the VAT. Okay, so it's a very progressive proposal. I've already mentioned raising the standard deduction would get 2/3 of the people off the need to file tax returns. And the VAT, I don't really have time to go into, but it's there in every other country in the world. It's a broad-based consumption tax that does not affect saving or investment, raises substantial revenue, and if it's kept broad, it can be relatively simple. European VATs have failed that test and have become enormously complicated, and whether your coffee beans are raw or roasted affects your VAT liability and stuff like that, or whether your nuts are shelled or unshelled. But it's sort of an example of what not to do. New Zealand, which has a newer VAT, has largely avoided those problems. All right, then Proposal 4, which we're calling the UBI proposal, but again, all the proposals have a UBI in them, is the same as Proposal 3, except you don't raise the standard deduction. Instead, you raise the personal credit by another $1,100 to $3,900. So it's not like the other proposals don't have UBIs and this one does, but in this one, it's being emphasized. The revenue from the VAT is being used to create a universal basic income, which you may remember just happens to be a paper that I wrote 4 years ago for the Hamilton Project. But a family of 4 would receive $15,600 in cash before it had to pay income tax and VAT. And let me skip this. And the combined 4 proposals, the distribution effects look as follows. And you can see they get successively more progressive with each of the 4 iterations. All right, I feel one more thing to talk about the effects of complexity, and then I'll wrap up. Frustratingly, the effects of complexity are the hardest thing to quantify. When I said that it's hard to measure earlier, it applies to these things too. But there are three things I want to emphasize. One is the filing requirement would go way down under proposals 3 and 4. And people would just not have to even think about income taxes. The second is the record-keeping requirements that are needed for itemized deductions, for some of the credits, for the EITC, et cetera, that all that would go away. And that the studies by Slemrod and Benzarti show that that's a substantial component of the compliance costs for low and middle and, the bottom 75, 80% of households, say. And also for the top 20, but they have other issues as well. And the ability to have one's returns successfully pre-populated by the Treasury would go up fairly dramatically under any of these proposals. So this is not hard data on complexity. It would be nice to get harder data, but everything we know about complexity suggests each of these proposals would simplify considerably. All right, so I end with 4 conclusions. We know how to simplify taxes. Doing so would help a lot of people. It's not going to be easy. The tax system is complicated for a reason. And having said that, when you compare simplifications to the other options on the table for 2025, simplification has some advantages and could be the time could finally be ripe for tax simplification. So David is going to show you a tax calculator in a second. This is the link for the calculator on the TPC website, and he'll show you how to get there from the TPC website. And then the background paper is on the Brookings site and the TPC site. Here's the Brookings link here, but you can also get to it on the TPC site. So that's a lot of talk about a simple issue. And thank you. And after David talks, David and I will take questions from the audience. Thank you.
All right, let's see here. Thanks, Bill. First of all, I want to thank all the people at TPC who helped put this calculator together. It was a group effort, team effort. But if this turns into a live demo fail, you can blame me. Hopefully not at the level of Elon Musk demonstrating the bulletproof windows on the new Cybertruck or Bill Gale failing on an iPhone demo, but we'll see how it goes. You can find a link to this calculator in the paper and places on the Brookings website and on the TPC website. So, for example, on the event page for today, if you scroll down, there's a link. It talks about a new feature on the Tax Policy Center website. If we click on that, that takes us to the calculator. The URL, in case you want to memorize it, is tpc-tax-calculator.urban.org. Now, I should say that this tool is designed to illustrate how these proposals work and what the potential impact is on different types of taxpayers. But I know April 15th is approaching, and while you may want to save a few dollars on your tax preparation software, please do not list TPC as your preparer, and TPC will definitely not represent you in the event of an audit. So with that said, we'll start off, and I'll take you through a couple of examples. So there's some introductory material at the top of the page, including a link to a methodology page, which describes some of the concepts for the calculator. But let's dive into doing an example. So let's start off looking at a married couple. Click the bar here. And by the way, when you have these choices for the boxes, you need to pick one in order for things to calculate. Let's assume they have 2 kids. So I'll select total children there. And let's assume it's a 2-earner couple. One spouse has, let's see here, $20,000, and the second spouse has $10,000, and we'll assume they don't have any other income for this example. I'm going to point you to this box down below here that says, enter the amount saved. This is not information that a taxpayer would have to fill out to calculate their taxes, but we use it to try to get an estimate of what the VAT would be under the two proposals that have a VAT. After you've entered the information for the proposals, you can click this box. We've entered it all. Now, this is the additional information we need to calculate taxes under current law. So in this case, let's assume the taxpayer is under 65, not in college. The spouse is under 65, not in college. Let's say they have one kid, age 0 to 12, a second kid, age 13 through 16. And even though this return wouldn't be an itemizer, I'm going to fill in some things here because they might need to determine that in order to calculate their taxes. So let's assume they have 500 in charitable contributions. We'll give them 500 in state and local income or sales taxes, and then let's assume that they have $1,000 in child care expenses. The next box can be ignored unless you have business income. This is just a question that needs to be answered to see if there is business income, if it's eligible for the qualified business income deduction under current law. Scroll down a little further, and this is the thing that's supposed to make things work. We'll find out if it does. Click Calculate Tax Now, and you'll see 5 boxes that will tell you what the tax liability is under each of these proposals, with current law first, followed by the 4 proposals. In this case, you'll notice that the taxpayer has a negative tax under current law and all of these proposals. That's because of refundable credits, and on balance, they're getting a payment back from the government. I should point out that we're only looking at income tax liability and not payroll taxes or state and local taxes, so this isn't the total tax burden of the taxpayer, but is helpful for comparing taxes. In addition to the bottom line number, if you scroll down even further, there's another box here you can click that says, see a detailed breakdown. So we'll click on that. And there you can see some components of the tax calculation. It's helpful for understanding what's changing from current law to the proposals. So, for example, if we look at the bottom line here, the total income tax and VAT, you'll notice in this particular instance, let me close that, sorry. In this particular instance, this taxpayer is worse off under the first simplification proposal, but better off under the other ones. And if you look at the preceding lines, you can see that their income tax before credits isn't very different under all the proposals. But in fact, if you look at the line labeled EITC work credit, you can see under current law they're getting about $6,000, and under the proposal only $3,000 from the work credit. And that helps explain why they're a little worse off. Under the other 3 proposals, though, the increase in the personal credit is enough to offset that. So on balance, they're better off. Sorry. All right, let's go back and show you let's do another example. Go all the way to the top here. Let's take sorry, my scrolling's not great here. Let's start off with somebody who's not married, no kids. Let's make them a higher income taxpayer. Let's say they have, what's my preferred example here? let's say they have $150,000 in wages. We'll give them $2,500 in taxable interest, $2,500 in dividends, and let's assume they've saved $7,500 out of their income. Again, that's the information for the proposals, the additional information for current law. Again, we'll assume that they are under 65, not in college. Let's assume they're going to be an itemizer. So we'll give them $5,000 in charitable contributions, $5,000 in mortgage interest. Let's give them $7,500 in state and local income or sales taxes. We'll give them $5,000 in property taxes. They have no kids, so there's no child care expenses. Again, no business income in this example, so we can ignore that question. We can go down and hit the calculate tax button now. Obviously, this is a higher income taxpayer, so they owe more in taxes. The comparison is a little easier to see. If we go to the detailed breakdown, and here you can see the taxpayer would owe tax, a little more tax in most of the proposals and a lot more tax under the latter two proposals. Again, for this example, the difference isn't so much coming from the income tax for the latter two proposals, but this VAT line. Sorry, I'm highlighting more than I need to here. That next to last line for the VAT shows you, if you're doing a decomposition, that that in some ways is responsible for the increase that you see for that particular taxpayer. And I think that's all I have for my demonstration. We would like some feedback, so if you have problems using it or you find bugs in it, please send us an email. I think we have a link on the site to info@taxpolicycenter.org, and I think that's all I have for the live demonstration. And I didn't fail.
So we have time for a few questions for either David or me. Kyle, let's start with you. There should be a mic coming around.
Hi, Bill. Kyle Pomerlow, AEI. You focus a lot on the trade-off, what seems to be an inherent trade-off between complexity and progressivity or equity. Have you thought about other trade-offs, like between economic efficiency and simplicity?
Yeah, we've looked a little bit at the incentive impacts on some of these, and of course, when the average tax rate goes up, generally the effective tax rate goes up a little bit, even though the statutory tax rate is unchanged. And we also looked at some proposals that would either maintain the distribution or actually be more aggressive, less progressive than the current system. It's very easy to figure out how to do that. You just eliminate taxes on capital income, right? But I just didn't think it was. Simplification didn't seem to be the main thrust of those proposals. So, yes, in the back.
Thank you so much. I'm Leah Sargent with the Niskanen Center. I'm curious, among the trade-offs, the complexity of the tax code obfuscates who is and isn't a taxpayer to a certain extent. And things like massively raising the standard deduction makes it clearer that many people wouldn't be under those circumstances. How do you think about the political implications of people having a different sense of whether they pay for the road or the war, et cetera, when they don't have a tax liability?
Yeah, that's interesting. The VAT, this is one of the advantages of Proposal 3 is that everyone does have skin in the game via the VAT. It's just that it doesn't have to be as complicated as it is for people on April 15th. Yes, there's a, come on.
That brings us back to the VAT as key to your proposal. What's different about the United States and most other places is we have states who have sales tax, and it would seem to me that's just an impossible thing to do in this country when you step on the toes of the states. Some states have their most valuable taxes as a sales tax.
Yeah, I think this is and actually a strength of a VAT proposal, not a weakness. If the federal government had a VAT, the states could conform their sales taxes to the VAT. The government could literally collect the money and send it to the states if the states wanted. And one of the advantages of the 10% VAT is if you add the average state sales tax rate onto it, it's a total of 16%, which is less than the European average, which is around 17 to 19%. But I think the fact that sales tax structures are already in place in some states shouldn't hinder and could help federal efforts to impose a VAT. But you'd need the states to go along. So in Canada, which has provincial sales taxes, they imposed a national VAT, and some of the provinces changed to conform to the national base, and some of them didn't, depending on what they wanted to. And if, you know, if a state doesn't want to conform and they want to collect their own sales tax that's different from the VAT base, that's their business and their right. But they would have the opportunity to conform with a federal VAT, which I think could be very valuable if they would take it seriously. Question.
Yeah, the tax system, the way it is set up now, serves purposes other than revenue generation. For instance, the Inflation Reduction Act, Section 25D in the tax code, offers tax credits to encourage the installation of solar panels and geothermal heat pumps. If the deductions and credits are removed, it seems that there might be a simplification of the tax system, but there'd be a shifting of complexity from the tax system to something else. How would the government achieve its non-revenue generating uses of the tax code today? Where do you see that complexity being shifted? What do you see the mechanisms for doing those sorts of things? Things like solar panel, geothermal heat pumps, the various other regulatory purposes of the tax system.
Yeah, if I understand your question, the complexity would be shifted to either the spending or regulatory side if the government wanted to maintain the same programs. I'm not sure I understood your question though, but it's kind of the income tax, although it's complicated per se, it may well be simpler than some alternative ways of structuring the benefits. So this comes back to the very first slide about, or one of the first slides about the themes about simplifying the interactions with government as opposed to just simplifying taxes per se. But I'm not sure I got your question right, so just catch me afterwards. We can.
If you don't do it in the tax code, how do you accomplish the non-revenue generating purposes of the current tax system if you don't?
Oh, okay. That is the great advantage of the universal to basic income, right? If you're subsidizing this group or that for this reason, then that group for that reason, this other group for that other reason, the universal basic income subsidizes everybody. So it takes everybody in the targeted group gets what they need, and then the cost of that, just like the cost of the simplified EITC, is that some high-income spouses of CEOs get it. The cost of the UBI is that some people that don't need it get it. And it's a trade-off. You can say it's worth it. You can say it's not worth it. I think on balance it is worth it, because it not only gets the targeted groups, but it fills in. There are a lot of gaps in our safety net. And it's very difficult to fill in one gap and fill in another gap and fill in another gap on a case-by-case or issue-by-issue basis. The UBI basically covers the waterfront on that, and so it could, in one fell swoop, it could address all those issues. Okay. Steve. Oh, I'm sorry. Yeah, Steve, and then.
Steve Tax Policy Center. what simplification efforts in the past have worked? And what was there about those efforts or the conditions at the time that allowed them to work? And can we see that again?
That's a great question. I mean, the major simplification effort was, in my lifetime, was 1986, and it was combined. There were a whole lot of moving parts where they tried to claim it was revenue neutral, and they tried to claim it was distributionally neutral with respect to income. Of course, there's no such thing as a distributionally neutral tax reform with respect to other criteria, because otherwise you just replicate the existing system. But with respect to income, it was supposed to be revenue neutral. I think, the simplification there came in the form of broadening the base, removing a lot of tax shelters. It was noticeably not directed at social policy in the tax code. So a lot of these policies that I'm talking about are directed at social policy and replacing them with a basic income. Any questions about the calculator? Yes.
I'm just curious, are you capturing any personal data about the users, like where they're, like what device they're using, things like that, besides just the information that they're putting in?
I don't believe we are, but I guess I wouldn't recommend necessarily putting your exact personal information in the calculator.
I'm not a computer person, but apparently it's possible to identify the device that somebody's using or where they're.
I can check on that and get an answer to you. I don't know how ours works.
Once TPC buys TikTok, the answer might change. One last question. Max.
Hi, Max Gennis from Policy Engine. It seems to me that one of the ways that you can at least visually understand the complexity of the tax system is just how much marginal tax rates change depending on their situation, especially low-income people face very high ones due to programs like phase-out EITC, but also benefit programs. It seems like you're addressing that to some degree. I'm curious if you've quantified it. I'm trying to think in my mind. I mean, certainly VAT simplifies that a lot, but still the 20% phase-out could kind of increase it for some people. Just is that a way we can think about measuring complexity?
Yeah, again, a great question. I think for a lot of people, on a lot of these reforms, marginal tax rates either change or go down. Like Proposal 3 with the $100,000 standard deduction, the marginal income tax rate is 0 for everybody, for 2/3 of the population. Now, they pay a VAT rate, which should be calculated, but it's only 10%. And I tried to impose some rules on the changes. One of them was not making up the revenue by raising rates. That seemed like cheating somehow. So we don't have the exact calculations and marginal rates, but my impression is they go down for a lot of people. They may go up for some on an effective basis, but not on a statutory basis. I mean, as you know, there's this tax rate structure with graduated taxes, and then there are all these phase-outs of different programs built in. Like all the phase-outs are gone in our proposals, except for Proposal 2, that one personal credit phase. Oh, I'm sorry, the work credit's still there, yeah. But generally, the work credit in the Proposal 3 or 4, where people don't have to file taxes, that would create a 20% tax rate as it was being phased out. So, all right, let's talk afterwards. Let's turn to our panel discussion. Thank you all, David. Thank you and the Urban team for everything you've done.
Names are on the chairs. All right. Well, good morning. Thank you all for being here and watching virtually. I'm Richard Rubin. I'm the U.S. tax policy reporter for the Wall Street Journal. And I've got a very knowledgeable panel here to talk about tax complexity with me. Starting on the far end, I've got Ariel Greenblum from Tax Analysts, Margot Crandall-Hollick here from TPC, and Natasha Sarin from Yale Law School. So I'll say something first and then let each of them kind of talk a little bit. I was actually glad that Bill started by talking about college sports because it actually to me is the best analogy for tax complexity, because you can imagine 100 years ago, right around the same time that the income tax was being started, they were like, okay, well, here's a couple different colleges and each of them have students who want to play against each other in sports, and okay, well, that makes sense. And then, well, okay, so let's have some rules and structure for that, and how do we make sure they're really students? So we need some rules for that and some enforcement mechanism for that. And then there's all this money coming in. Can the students, can the schools give them scholarships? Okay, well, we need some rules and to build around that. And then you have this whole and then it kind of made sense for those university programs to be effectively minor league sports operations. And then, so now you have this whole apparatus that's built around something that makes no sense, which is having, minor league sports inside of universities with all this complexity around it, and it's completely path dependent, and it's exactly like the income tax. And it's untangleable. But maybe today we can find a path on both. So let's just start on the end, and Ariel, just start, Give some thoughts on complexity, and then I'll ask some questions, and then we'll open it up to the audience.
Okay. Hey. Good morning, Richard. Good morning, everybody. Thanks to the Tax Policy Center for inviting me to participate in this panel, and thanks to all of you for attending in the room or online. F. Scott Fitzgerald once said, "Let me tell you about the very rich. They are different from you and me." Yes, high-income individuals are different, including in the number of tax provisions that they can take advantage of. I call that tax complexity. There are plenty of examples. For instance, the taxation of hedge fund managers and real estate investors, or how the tax code treats trusts and borrowing against capital assets. In general, the code favors capital, and the more you can invest in it, the better off you are compared to those who earn only a salary and pay ordinary tax rates. The capital gains rate is generally 15% or 20%, depending on your income. That's pretty good, especially because the marginal rates on ordinary income go all the way up to 37%. Speaking in broad terms, one way to simplify the code would be to close the capital gains differential and tax capital gains at the same rate as ordinary income. But that might be a bridge too far for Congress. In fact, the last time we did that was almost 40 years ago. So maybe Congress could increase the capital gains rate and get it closer to the ordinary rate. And that would give high-income taxpayers less of an incentive to turn their ordinary income into capital gains. And that would help start to simplify things. But Congress would have to resist the temptation to once again widen the gap between ordinary income and capital gains. So I'll leave it there, Richard. I look forward to more of a discussion here.
Great. Margot?
Yeah. My name is Margot Crandall-Hollick, and I'm at the Urban-Brookings Tax Policy Center, and I work on low-income tax policy. So often we think of the tax code as collecting revenue, which obviously it does. Before the pandemic, it collected about $2 trillion of tax revenue. But it also pays out a lot of benefits, which Bill mentioned in his presentation, the Earned Income Tax Credit, the Child Tax Credit, tax benefits for childcare, and all sorts of other benefits for low-income populations. And those benefits before the pandemic, the biggest two you probably are familiar with are the Earned Income Tax Credit and the Child Tax Credit. Those two benefits were about $100 billion. And sometimes we think that's not a lot in the tax system, But in the benefits world, for low-income people, that's a lot. There's an idea out there that there are a multitude of benefits that low-income populations can take advantage of. And that's, while there are a multitude of benefits, many are not eligible. So many people get two benefits, the refundable credits and food assistance, or SNAP. Right? Those are the two most prevalent benefits. They are, aside from, I should say, I don't want to get my friends who work on Medicaid or CHIP angry at me. Those are even larger. But tax benefits provide cash to people. They provide unrestricted cash. They have been incredibly politically popular if they are predicated on work and having children, as any of you following the child credit debate would know. But they're also incredibly complex, not only because of the benefit schedules, which Bill's proposals simplify greatly, but I really want to stress the eligibility rules. You can have a child who makes you eligible for the EITC, but they're too old for you to count them for the child credit. You can have a child that makes you eligible for the child credit, but doesn't make you eligible for head of household filing status. You can have child care expenses that you're paying out of pocket that do not qualify for the child independent care credit. And navigating that maze is what is complex for low-income populations. When you do their taxes, I know some of you do VITA, and I just did it for the first time this year, preparing taxes on a volunteer basis. What you recognize is navigating that maze is what, in a way, delegitimizes the system to the people using it. Why are the rules the way they are? But it also just makes it very stressful. And one of the measures that I don't think we often think about is the improper payment rates. All those refundable credits are included as improper, they have to be counted as improper payments if there are improper payments in those programs, and they're really high rates, right? And that's not necessarily because people are gaming the system. That can be a grandmother who is raising a child, but because of the EITC tiebreaker rules doesn't qualify. And so I think one of the things I like to talk about, or is really important, is when you're writing legislation, writing those rules. We spend a lot of time writing rules to keep people out. And Bill gave a great example of, we want to make sure that the child care expenses don't go to the couple in Aspen, right? But to do that, first I think we need to start quantifying how many couples in Aspen would be using this, but also what's the cost of all the people who now have to go through all those gates because we wanted to keep out the couple in Aspen. That's the question I think policymakers need to ask themselves when they write those rules. So that's all I have.
Great. Natasha?
Hi, everyone. My name is Natasha Surin. I'm a professor at Yale Law School. And before joining the Yale faculty, I had the privilege of working for 2 years in the beginning of the Biden administration at the Treasury Department, where kind of my remit was tax policy and tax administration. And so I'm very grateful to Bill and to all of you for being here for a conversation around tax simplification. Because, and this relates very deeply to what Margot just said, when you're in the midst of legislative debates, I feel like there is actually not enough attention given to the nature of the complexity of the code and the nature of how changes from a policy perspective are going to make it harder to implement, not just and we should talk deeply about taxpayers, both high-end taxpayers and low-end taxpayers, and the way we can achieve greater simplification along the lines that Bill is describing in his proposals. But it's also, frankly, and this is the piece that I got to witness most closely, it's from the perspective of the IRS as well. Mm-hmm. Because from a tax administration perspective, they actually don't have control over how the legislation is drafted, but they're told to implement against it. And when the rules are as complex as they are, it becomes, and the agency has long been underfunded in ways that are deeply problematic, it becomes not just a Herculean task, it becomes a fully impossible task when you're dealing with an agency that collects 97% of the revenues of the federal government and is the largest administrator of federal benefits in the government. So that is hard, and we should all do our part with respect to talking about the ways in which simplification can deliver us very significant gains. I think Bill started us from a point where I hope we will go in this conversation, which is why is the tax code so complicated? And I actually think like if we were starting from scratch, and this is also related to how Rich started us with like the income tax and the NCAA tournament that is coming our way. But like if we were starting from scratch, there's a question like, would you write the rules the way they are? And I actually genuinely don't know the answer to the question, because some of it is about like preferencing particular groups in how we write the code. And some of it is about this like iterative thing that like you drafted it one way and then you make a change and then you draft it sort of iteratively in a way that you never would have structured it had you been starting with like a vision at the outset for what the code should look like and what it should seek to achieve. And I think all of this poses a deep, and I'm like an economist who teaches, and so I'm not like the world's leading, I'm not even the world's leading, I'm not a deep political scientist or political thinker in any way, but I will say like, just like watching some of this, the like politics of all of this strike me as deeply complicated and challenging, because while simplification is like a super desirable goal in theory, and like you're not going to find people being like, no, I actually want the complex code, like I want it, I want the 15 pages of the EITC eligibility rules, I'm like here for it, like no one's going to do that. But as you start to get to actual conversations about what moving towards systems like Bill has proposed would require, you will start to get sand in gears very quickly from policymakers who are seeking to preserve X preference for X group, or who are reluctant about extending X benefit to a group that feels too broad. And so actually how we get from we all want simplification to structures that allow for simplification is a super challenging question, and one we should all grapple with ahead of 2025. And in doing so, reflect a bunch on what Steve is asking, or was asking Bill earlier, which is like, what are recipes for success that we've seen historically with respect to actually achieving some simplification goals?
Ariel, I wanted to jump off that and see if you could talk a bit about, like, you know, Bill talked about 1986, but in some ways what his proposal builds on what we've seen over the past, you know, since 2017 with the reduction of the number of itemizers from about 30% to about 10%. Like, can you, how much simplification, you know, was achieved in 2017, and what does the past 8 years sort of show us?
How much simplification was achieved in 2017? Yeah. I don't think very much. From what I've read, Richard, about the act, we gave, let's see, Bill mentioned section 199A, and so that was put in there to achieve some kind of parity between partnerships and then corporations, because one of the main points of the TCJA was to bring the corporate rate down, and it did. And so the lawmakers really did not want partnerships to feel left out. So they gave they did the 199A, which provides a sizable deduction to partnerships based on their qualified business income. So if we want to simplify the code and promote progressivity, I think we should definitely let 199A expire in 2025. That's just my humble idea. It's not mine alone. Let's see. So partnerships got 199A, even though after-tax corporate investments were going to be on par with after-tax partnership investments. And that's because of the tax rate for corporate distributions is what it is. So, yeah, it adds complexity. We didn't need it to begin with. What else? Mm-hmm. Okay.
And then, Margot, you talked about the, you know, refundable credits that low-income households get, as sort of in relation to SNAP and CHIP and Medicaid. How would you sort of evaluate the level of complexity of those other programs? Like, is SNAP more complicated to deal with and CHIP more complicated to deal with? And are there lessons for refundable credit administration and design from those non-tax programs?
I think those, I'm not an expert on SNAP or Medicaid or CHIP.
Neither am I, that's why I asked.
But I think broadly, a lot of the people who do work in those programs would say that they are very complex. And not only are they very complex, but you often have to apply for them periodically. There can be a lot of stigma associated with that. With the tax code, insofar as you're pulling data elements that are already provided, you've provided your earned income, you've provided your AGI, they can be much simpler. They are done at tax time, so you're kind of part of the system, if you will, but you are not seen as a, taking from the system as opposed to providing taxes to the federal government. So I think there is an opportunity, and the issues about qualifying child rules, I think, would be very similar issues outside of the tax system. Like, who gets to claim a child, whether it's a tax benefit or a benefit run through HHS, I think is going to be a really complex system. To Natasha's point, the IRS doesn't have the tools or capability to do that. They have long been, focused on enforcement with tools around enforcement. Some of the IRA money was for taxpayer services. But I think if we're going to acknowledge that there's always going to be some complexity, multi-generational households, people moving in and out of the house throughout the year, then we might also want to think, instead of trying to prescribe really detailed rules to get every last household, having broader rules and having more services funded through the IRS so that they can actually help taxpayers. So you get one person who helps you through the whole journey of doing your taxes, things like that. But of course, that would take funding.
Well, I mean, the IRS does have some additional funding now. You haven't been there in a little bit, but Natasha, can you sort of talk about what it is that the IRS can do, even given the current tax code, what a well-funded or better-funded IRS could do to reduce complexity or help taxpayers navigate the complexity that exists?
And what's super exciting is they're kind of already starting to do some of this work. And part of what they have launched for this filing season is a system of direct file where you can, if you're an eligible taxpayer, sort of file your return directly with the IRS, saving your $130 and hours of time that you spend with a paid tax preparer. And that system is built on, it has like two component parts that are challenging for the agency. One is there's like a ton of technological deficiencies that exist at the IRS because they're running on IT systems that are like from the 1960s. So like they're just like running on systems where even comparing the same taxpayer to themselves over time or pulling information about a particular taxpayer over time is something that's ultimately pretty challenging for them to do. And then there's a service component, which is it's not just like, let me provide you like a chatbot who helps you do direct file. It's let me help you answer questions about eligibility when the rules themselves are incredibly complicated. And the thing that I think is so important and interesting about what the IRS is doing right now is they describe their work as kind of a fundamental shift with respect to how they think about accuracy. Because historically, how the tax administrator has thought about accuracy is kind of through the lens of enforcement. So like, it's like you're accurate if you like pay your tax liability in full. And now what the IRS is thinking about and trying to design structures for is you kind of need accuracy on both sides of the ledger. So like, it's not just like you need accuracy with respect to your tax obligations. It's also that if you're deterred from claiming benefits because of the complexity of the system, that is a problem and a tax administration problem ultimately that the agency is like seeking to solve. I'll say something that I think is, so I'm doing some work right now on tax complexity, and something that I find really interesting is that if you look at tax filers in the US today, the IRS currently has, through information reports, enough information about 40% of filers in the country to be able to pre-fill returns. It can't do that right now for like a whole host of reasons. The timing of the information reports and the fact that the technology is where it is. So like we're like a little bit away from this like vision dream state. But the vision dream state is like within attainment and that is a real way to reduce complexity from the taxpayer's perspective, because it just means that you don't have to do, to Bill's point from earlier, slightly different numbers for slightly different programs, but like you don't have to do anything. You just, as in many other countries, you fulfill your tax obligation by like saying yes to a text message. And so getting us from where we are today to that system in the United States is like something well within the realm of possibility. It is not going to be attainable without the resources that the agency needs to be able to shift from like a 1960s tax administrator to a 21st century one. And that's part of why I think this funding is so critical and important.
Jumping off Bill's proposal, I'm curious how, for anybody, how you think in terms of Americans would receive a VAT in terms of, both like, liking to pay, or would people find it simple, right? Find it simple, like it would be novel, right? So how do you think people would kind of judge the newness of it and the, it's similar to sales tax but not, right? Like how would that kind of get received by people as an addition to the tax system in terms of complexity?
Don't everybody?
Whoever wants.
Yeah. I mean, I don't think the appetite is there. Personally, I mean, nobody wants their after-tax income to increase, and I think that there would be such a concern that like going to a VAT kind of system, even if you added some other things in, I mean, I can see this becoming such a political issue, in Congress saying like, what are we, a European, are we a welfare? I mean, this would be all that on, I don't know. Like maybe we should do that, but I think it would be very, very difficult.
I think Bill's proposal belies him as an economist because which he is. So like
that's a compliment.
That's a compliment. It's a deep one. It's like the reality is like if you poll a bunch of economists who think deeply about tax, they will all want a VAT. So like that's like it's like fully within the sort of scope of where deep academic minds who think about tax policy think we should be, given our revenue needs and the simplicity of a system that, if you design it properly, and we talked a little bit about improperly designed VATs as well, that can accomplish a fair amount. I think the challenge that like we're gonna find in Bill's proposal, if you like delve into the nuance of it, it avoids, then you look at all of his sort of distributional tables, you see that it doesn't do what I'm about to say, but like the perception of a VAT is that it is a regressive consumption tax. Mm-hmm. And so like, I don't know how you start from that point, even if you design it in ways that it's not that. That's kind of where you're starting from. And in the political discourse, like where you're starting from, it seems like has a huge sort of driver of how people ultimately perceive policies, even though they're nothing like in structure what they're described as. That said, I don't think we should like diminish the importance of the work in some sense, because part of what I've been struck by, and I'm sure everyone here has been struck by over the course of the last decade watching tax policy, is like smart academic ideas that have even been about like ultimately reviving other ideas that have existed in the past, have really expanded the Overton window of like what we're talking about is in the realm of possible. So things like mark-to-market taxation or wealth taxation, like a decade ago, we weren't really like having the same sorts of structural conversations that we are, or seeing legislation drafted along these lines. So like, I think it is all for the sake of good. And in part, I think it's all for the sake of good because I think we're not like fully grappling yet with the scope of how significant our revenue needs are likely to be over the course of the decades to come. And we're going to need something that is pretty novel and different in order to meet them.
So like the 2044 presidential campaign?
Yeah, exactly. That's what they will be calling Bill.
All right.
Yeah.
Margot, can you talk just, how do you think filing complexity and complexity for low-income taxpayers would change under something like what Bill's proposed here?
Well, Bill's proposal for a personal credit reminded me a lot of the eligibility rules for those stimulus checks, and that it was very straightforward. It was, you're not a dependent, you're not an estate in trust, you're not a non-resident alien, we're going to give you a payment. So I think if the rules were relatively simple, I think it could be simpler for many. I think there would be some people who would be missing out. Maybe their kids are too old and they could get the EITC and couldn't get the credit under Bill's proposal. So you're always going to have losers, and that's when the carve-outs start, which is politically hard to resist. But I think that he's gotten rid of almost everything that I work on, so it's made my life a lot easier. The child independent care credit gone, FSAs I think gone, so all of those things, there's less of a maze to have to navigate, and you have to answer those questions once, so it's implicitly simpler. The losers and winners is, I think, where a lot of the focus, if we were drafting legislation, it would be.
Yeah, so I wonder if one of you could talk about the losers and winners. You know, the Bill raised the charitable contribution as among the politically hardest. It occurred to me that remembering 2017, the medical expense deduction is also, you know, not just FSAs, but, you know, for people with, you know, cancer and chronic illnesses who have high medical costs, that becomes a big issue. So I'm curious sort of what the sort of political path might look like to overcome, you know, what are very sympathetic sounding arguments that are, you know, for complexity in a sense, but that you know, would make it harder to go to that kind of a system.
So a thing I wonder is, like, and we said 2 sentences about TCJA, but like we can maybe say 2 more. I think trying to achieve some of what Bill has laid out in the name of decreasing complexity is going to be hard, because you're going to have every single sympathetic, every component is going to have a sympathetic part that you raise.
I mean, it's lobbying, but it's not like, you know, it's not like it's in charitable industry, right? But it's lobbying that has a very like welcomed ear in Congress.
Yeah, but when you like raise the standard deduction so fewer people are itemizing, you have achieved something from a complexity standpoint, and you've done so in a way that kind of like insulates you some from those conversations about like you're hurting that party or this party or this group of lobbyists is going to get mad at you. And so I wonder if there is some way to think about some of what Bill is describing as not like, you know, you're down on particular parties or particular groups who you're disadvantaging, but instead about you're being more generous with respect to a standard deduction that has as its virtue that it makes life easier for filers, as opposed to we're making life easier for filers by taking away from them. It's kind of like a different framing to the same exact proposal.
Yeah, and I think having lived through the TCJA legislative experience, it was sort of a stress test of where those sympathetic points were. Mm-hmm. So, you know, they tried in the House to, you know, really ratchet back the state and local tax deduction, and found that ultimately, like, the political forces landed on 10,000. The other one that members, you know, told me at the time were they got rid of the tax credit for rehabilitating historic buildings in the first House version, and then like they realized that was like a hot button, and like every member like had projects in their districts and came to the Ways and Means Committee and said, no, you can't do that, and so that got added back. And so I think there's, you know, these proposals themselves politically can reveal where things are dangerous. Yeah. I've got a question that came in. We'll get some audience questions here shortly. This is one actually that goes at similar sort of adding complexity, but worth thinking about. It's from online that came in yesterday. How can the tax code incorporate regional average cost of living and pay? On the EITC, in San Francisco and the ITC in Amarillo basically are very different kinds of things, but they're all based on national income levels in the national tax code. So is there a way that the tax code can incorporate that, and how do you sort of weigh the efficiency benefits of maybe doing that with against the complexity?
You want a regional EITC?
I don't. Who are the right?
I mean, there are,
This guy does.
most states have EITCs, so I would say that as a backstop, and we've done a lot of work at TPC on the state tax benefits that mirror the federal tax benefits. I am not a lawyer, and one of my best friends is a tax lawyer, so I'm not going to answer about whether you can legally do that. She would get very angry at me. But I do think that, again, you have to weigh the benefit of doing that for a certain number of taxpayers to the complexity and the errors that are going to occur, the improper payments and all of those things. So I think you have to weigh both of those. And then, again, we do have state tax systems which do bump up some of those credits. And they are, for a lot of people, they just experience it as tax time. It's not federal and state. It's just the big check that's cut. What their taxes are is what their refund is. So, from their perspective, it's just a pool of money. And I would be less concerned with that than simplifying the qualifying child rules. I really would love to have questions about that.
How would you do that? What is how would you simplify the qualifying child? Is there one definition that's?
No.
You sort of laid out how.
No, usually you'll have winners and losers based on age, right? Because the EITC can be available to low-income families that have kids in college. I don't think. My colleague Leimag has written in the past about, if you want to have tax benefits for higher ed, just put that in the higher ed bucket and make it clear. Create kind of a unified age of maybe 18 years old, and then it becomes the tests about residency and relationship, which I think got a lot of attention with the ARPA expanded credit. And I think there's kind of a push towards mirroring the complexity of family lives in the legislation, as opposed to a broader approach of maybe letting that family in Aspen get it, but having millions of other people have a simplified experience because of that.
We can start opening it up to questions here if there's anyone right in the second row here first. Yeah, and then go to Scott.
Good morning. Thanks so much for being here. I have two questions. The first is on partnerships, so at the top of the distribution, and the second is on the EITC in the bottom of the distribution. So with respect to partnerships, it seems like there's some low-hanging fruit with respect to simplification. Like right now, doctors and lawyers are getting treated differently from architectural firms. This seems super arbitrary, unless you're, in the real estate industry or something. And I'm wondering, what avenues do you see towards partnership simplification, especially considering, the high percent of the 1% that receives their income through these pass-throughs? And what do you see in terms of political economy challenges there? And then the second one is that we know on the EITC now that Black taxpayers are audited 3 to 5 times at the rate of non-Black taxpayers. And on the other hand, partnerships are audited at a 0% tax rate. So I'm really curious what you think potential avenues to kind of, smaller that gap between the differential audit rates and their implications could be.
Great, thank you. Do you want to take?
So maybe I can start, and then others should fill in as well. I was actually going to talk about this great paper that Dan Ho and Jacob Golden and co-authors have written about enforcement with respect to the EITC and the sort of equity lens through which we need to view all of these questions that we're talking about today. Because we don't actually know, and they don't know in the paper, how the IRS makes enforcement decisions, what the algorithm is. No one knows anything. But what they speculate and what could be driving those trends that Black taxpayers are 3 to 5 times more likely to be audited, even among the same income class, even among the same credit recipient, than white taxpayers, actually has to do with the complexity of the rules. Because the nature of the IRS's algorithm, potentially, we have no idea, but what the authors speculate is if this is how the algorithm works, what it does is it looks for binary 0-1 mistakes. as opposed to trying to look for the aggregate amount that has been overpaid or underpaid to particular taxpayers. And if you're looking for binary 0-1 mistakes, the fact that the rules are so complicated, and particularly complicated for families with non-traditional family structures, is going to create disparate impacts. And so part of what we can accomplish through simplification is not just making an easier filing experience for taxpayers, it is also creating a more equitable tax code that doesn't treat similarly situated taxpayers differently because of choices that they've made with respect to how they organize themselves or how they organize family structures. And I feel like that's a super important and under sort of appreciated fact about some of the proposals that we're actually talking about today. In partnership land, the one pitch I'm going to make very deeply is I think that 2025, to Bill's point, provides us a sort of opportunity to think about tax reform in a way that's much broader than just do you extend the expiring provisions of TCJA or do you not? And one area where I'm hoping to see actual progress is with respect to partnership, where you actually have great legislative proposals. Wyden had one that was released last year that would make substantial progress on some of the questions that you're asking. And also, a pitch for myself, I'm organizing something called the Tax Reform Project out of Yale, which is looking for ideas from practitioners across the code to achieve simplicity, but also to raise substantial revenue to meet our needs. And partnership is an area of substantial focus because there are statutory changes that are sort of low-hanging fruit-ish that can accomplish a fair amount. And so I'm hoping that we're actually going to see conversations about some of that in the months to come.
Anyone else wanted to jump in?
Yeah, I mean, I would add to what Natasha said. There was a really great 2020 Treasury study that was looking at improper payments, right? This measure that often drives people's there's fraud here, we have to look into it. And what they did is they looked at the social welfare implications, and they looked at those families that were improperly claiming children. And oftentimes it was a grandparent or an aunt and uncle claiming that one, the child. But because of the tiebreaker rules, maybe it was a grandparent who didn't work, who did all the caretaking. They weren't actually eligible under the rules that were tightened up in 2009. And so I think, to Natasha's point, we do have these we have complicated families. We have multi-generational families. The EITC is notoriously problematic because multiple people can often claim one child. And then if they do, there are these rules that seem kind of haphazard and don't make sense. I might have provided more care, but I can't claim them because my income is too low. And so I think looking at all of that holistically and looking at that eligibility rules, again, to accommodate those families and to recognize that the care of children is complex. Probably don't want the government knowing everything about your family. You just want to get the benefit for that particular child. So I think it starts obviously with the rules.
All right, just one more thing about the partnership. So I would say that there is potential for partnership reform if we sort of get away from the idea of tax simplicity for a second by treating all partnerships the same, because we have got to separate out the small partnerships from the larger partnerships, such as private equity, and getting at this carried interest situation for the hedge fund managers. And so we got to separate it out. It's exploded. We're not where we were in 1986, certainly with regard to partnerships.
Scott was next, right? And then we can go to Pat Mahomes in the back.
Hi, Scott Hodge with the Tax Foundation. I want to pick up on something Natasha said about starting from scratch and the decisions you have to make. And I'll kind of bring it back to Richard's opening statement about the NCAAs. If we're starting from scratch, we have two decisions to make. Do we want a tax system that's simply going to be there to raise revenues for the government? Or are we going to use the tax system for social and economic purposes? And so the decision is that once you start down that road of using the tax code for either social, economic redistribution or what have you, then the further you move away from neutrality, then you get the complexities that you're talking here. So I was reading the floor debate Senate floor debate from 1909 when they were creating the corporate income tax, and they started exempting certain industries from the tax. Well, today we have the NCAA that's going to collect over $1 billion worth of TV revenues from putting on March Madness and pay no income taxes. So it seems to me that the real debate here is not whether we can simplify these rules over those rules, but the basic question is, do we want a neutral tax system or do we not? Do we want a tax system that's going to be there for redistribution to incentivize certain types of industries over others? That's where you really get the complexity. So we really need, it seems to me, a debate over neutrality. There are neutral tax systems out there, like the Estonian tax system. So shouldn't that be our goal rather than trying to go through all these machinations to create some sort of an ideal system?
Okay, anyone want to jump in on that?
I mean, I'll just say briefly, if we're going to have if neutrality is what we're going to prioritize in the tax code, I mean, I think that would get away from progressivity, which is what another principle or another goal of the tax system. So I think that they might not be incompatible, but they could be.
Well, we're having a debate over partnerships, whereas the real question is, do you want to tax C-corps differently from pass-throughs? Or
Totally.
do you have a system that treats all businesses roughly the same?
But I guess like my sort of response is that I think you're asking like a broad question that is important, which is like, what is the tax code for? And I think that is like a question that is worthy of a fair bit of debate. The piece that I differ, it's not going to surprise you when I tell you this, Scott, but the piece where I differ from you is like, I'm not sure that thinking about the world as like the tax code can either be neutral and not progressive or raise revenue in a simple way is like exactly the right frame of mind to have about what the code is able to accomplish. And in fact, I would offer that a whole host of the complexity that you see in the code is not because we're like using it in ways that are super progressive and like redistributive. It's because we've made choices to preference certain types of structures and certain types of industries in ways that allow the sort of 40% of the untaxed capital gains of the top 1% to constitute all of their wealth. And so as I look to sort of evaluate tax reform proposals, I tend to do so with an eye towards revenue raising as an incredibly important principle, but progressivity as an incredibly important principle as well. And there's a question that you can reasonably ask about how much the tax code can be expected to accomplish. And like we're talking about, when we talk about some of what the tax code does today, like it is, or what the IRS does today, frankly, it's administering big parts of Obamacare. It's like it's sending out checks during COVID to 88% of American households. So like how all of this and why the IRS is like the agency that's doing all of that has to do with their competency, frankly, to do all of that at a time when they've been very under-resourced, and has to do with the fact that the structures that exist to achieve some of those important social goals, in my view, don't exist outside of the tax system in the way that they exist inside of the tax system. I think it's like totally worthwhile to have a conversation about whether that's the dream world that we all should inhabit. But I think it's a mistake to say that there's not scope to raise revenue in ways that are super progressive. And in fact, if you look to the Biden budget that was released last week, the Biden budget that was released last week, you'll see $3.5 trillion of super progressive revenue raisers. So I think there's scope to do both.
And I would say that some of the complexity too comes from attempts to from the fact that simplicity itself opens up avenues for avoidance innovation. So you think of something like the hobby loss rules, like just a 7-factor test about whether someone's activity is business income or not. Well, like if you didn't have that, people would stuff all sorts of stuff and make it deductible. So like there's some element of that makes it, where simplicity can, particularly at the high end, can cause real erosion of the tax base. In the back, and then I think Tracy was next.
Don't most of the changes that you're talking about shift the tax burden to those who have the resources to fight those changes?
this is like a deep, this is another deep question, because when I had a paper at Hamilton last fall that was a version of like Kim Klossing and I's view of how we should approach the tax reform debate in 2025. And it had a whole host of conversation about partnership tax reform like embedded in it. And when you present it to practitioners, what they'll kind of tell you is as the IRS is making substantial progress with respect to trying to open more partnership audits to get its audit rate above literally zero. It's literally zero. They open 7,500 audits each year. They get 4.5 million partnership returns. That's zero. What they'll tell you if you talk to practitioners is like, aren't you kind of like, we support you, we should fund the IRS, we should do all the stuff, we should change the rules, we should make the world less complicated, but like, it's kind of David and Goliath in an inevitable way, right? Because whatever resources...
In which case the IRS, the U.S. government is David in this?
The U.S. government, David, yeah. Because whatever resources you're able to levy against this sort of challenge, you're going to be up against like 10 times, 100 times the resources on the other side. And I like totally take the point, right? And that is just inherently true when we're talking about some of these large and complex types of taxpayers. But like, it kind of can't be the world that you live in where you say, as a result, we're not going to bother with respect to thinking seriously about the rules and thinking seriously about enforcement opportunities in high-end complex cases because they're just so well resourced. The answer has to be that like you marshal resources to the best of your ability, and you also think deeply about the ways some of these simplification proposals can help, not just from the perspective of like making life easier for taxpayers, but also, as I said at the beginning, about making life easier from the perspective of tax administration.
Tracy, and then here in front.
Hi, Tracy Gordon, Tax Policy Center. I have another deep philosophical question. TPC was literally founded to bring the same high-quality data, facts, and analysis that exist in the halls of government to everyone so we could have more informed debates. And yet, I remember early in the Obama administration, Austin Goolsbee, who was then working for the administration, came to the National Tax Association meetings and said, we're looking for revenue raisers similar to the tax reform project. And we have this pledge that we're not going to raise taxes on people less than $250,000 a year. We welcome your ideas to everyone at NTA. And hands went up immediately and said, do you mean everybody who earns $250,000 a year, or the average, the midpoint of the little bin? And Austin, who's very funny, said, wait. I know that if this crowd, if anyone, is going to come up with like the one guy who earns $250,000 a year, whose taxes are going to go up, and it's all parsonage income, there are these very esoteric examples. And so for those of us in the analytical community, I worry a little bit that things like this tool make tax simplification harder because you're illuminating for people who is going to win and who's going to lose. So what do we do?
I'll actually take that one. I think it's a sort of one of those cases of what gets measured gets done, right? So like we have, in part because of TPC, we have really good measures of distribution, right? Any proposal that comes out, like there's distribution tables. Any proposal that comes out, there's revenue tables. There's not a complexity table in the same way. And so I think it's not in the conversation. I mean, others can talk about this too, but I feel like when there's a proposal on the Hill, it'll talk about simplicity, but there's not a number attached to it in the way that there are on the revenue and distributional sides.
Yeah, I would totally agree. During the Build Back Better, before it merged into the IRA and then became something else, there were definitions out there for a new definition for children for just the child credit. And it was going to be monthly. And I won't get into all of it because it was many, many pages, and it's in the Biden administration proposal. And I remember trying to explain, even to myself, this is more confusing than the current proposal, which is also very confusing. And how do I measure the confusingness that a taxpayer is going to face, the improper payment rates that are probably going to ensue by people who make unintentional errors and fail to comply, the audit rates of people who are then deemed to be claiming something they're not supposed to? How do we just have to kind of wait for that story to happen? And it's a frustrating thing because what measured, matters, and we don't have this complexity index when bills come out. So, maybe the next iteration bill will be a complexity index.
And then last question is here in front. We're almost out of time. Just wait for the microphone right up here.
Yeah, Bob Wyman here. Much of the conversation has been technical in approaching the problem of simplification, but it seems to me that we're sort of skipping over the fact that there are very significant philosophical and moral questions here. For instance, tax simplification, if it's done in the way that's been discussed here, seems to be significantly constraining governments, the richness of government's ability to operate within at least one very significant realm of potential activities. There's a moral implication as well in that when we go for neutrality, when we view horizontal equity based on pre-tax income as important, we're sort of buying into the myth of ownership. Murphy and Nagel told us not to, and we're giving a potentially greater importance than should to pre-tax income by doing that. There are very moral questions involved here, and I'm wondering. I know it's easy to talk about this as a technical problem, but how do we enrich this conversation so that it does include a discussion of, what is the proper role of government? What is the proper realm of government activity? Should the government be able to have a complex tax system? Perhaps not the complex one we have, because the one we have has a lot of complexity, which is just silliness, or it's privileges for people. But do we really want to say that the government cannot, for good reasons and with good purpose, introduce complexity into the tax system? Do we want to constrain it from being able to do that? Do we want to say, because we desire simplicity, that we will buy into, for instance, the myth of ownership, if you accept that, and that we will assume that pre-tax income is in fact a correct distribution? How do we deal with those questions beyond the questions of the technical ones, and can we put together nice calculators, and can we make it quick? How do we deal with those very fundamental questions of what is our government, how should government work, and what are the moral questions here?
Who wants to do moral philosophy of taxation in 72 seconds?
Exactly. I will say, the one piece that I think is it's like a great question because it brings me back to, even though I'm in DC today, it makes me think of being at the Yale Law School and having versions of this conversation with my students. I think that there are, and this is also Scott's, what is the tax code for? What is the tax system for? What type of levers do you want the government to be able to operationalize for what type of groups? All of these are incredibly important and first order, they're political economy questions ultimately. And they're questions that I worry we're not sort of engaging with in a super deep way. In part, Michael Gratz has this great new book that's kind of about the rise of the anti-tax coalition, where it talks in part about how 44 Republican senators have signed a pledge saying they never want to see any tax increases on anyone. And Tracy was talking about the pledge. You've seen versions of this across the board, and it's not like a single party type of issue and type of question. And so if that's the sort of politics of taxation, then you're kind of not having your broader moral and philosophical questions about what we want the code to be able to accomplish in ways that I find deeply sad and problematic. So I hope that this conversation, that said, we also need to have a conversation about all of the technical components that are actually going to be on the table when we're doing tax reform in 2025. But we should have both of these conversations, and they need to be done through the lens of tax is an important tool and vehicle to help achieve societal change, as opposed to an aversion fundamentally to the politics of taxation.
Great. Back to, we're out of time. Thank you, Ariel, Margot, and Natasha, and back to Tracy.
Okay, thank our panelists. Thank all of you for terrific questions. And for those of you who are eager to continue the moral and political conversation, there's going to be an event here at Brookings again on April 3rd with Michael Gratz talking about his new book. Before that, we're going to have a virtual event on racial preferences, preferences for housing and how they play out by race and ethnicity as well as income. And that'll be a virtual event on April 2nd. So good luck in the tournament, filling out your brackets, and we'll see you all here again soon. Take care. Thanks.
Thanks.